the way I have looked at this personally, and again, remember, guys, before you place any trade, you have to fully understand all possible outcomes of it. Okay, I am quite happy with the level of dividends from the current level. Okay, and of course, if I look for buying long term, I know by technical analysis it still can go down, and I will be doing exactly the same as Nick does. So I will wait until it finds a support. When I see a couple of waves, I might not wait until it goes to $45, but if I see it bounce from $29 or $28 and then doesn't go lower than 28 and holds $28 level, so for example 28.32, 28.32, I might enter there. Okay, I might buy it. Or alternatively, what I can do is buying it now, but then use a stop loss to protect myself. So, and if it keeps sliding down, I will exit the position with a stop loss, and then I will buy it even cheaper. So this is kind of protection to do that, because I don't want to lose 30% on the growth and buy it after it goes 45. So I might also benefit from that type of profitability. But then based on technicals, I want to protect myself, so I might put a stop loss. Okay, in this particular case. But for long-term hold strategy, so if you buy at $25 or $28 level, so it's a bit lower than right now, and then hold until 59 to 75, it's whatever price range we identify based on our calculation. So this is possible period waiting 2 to 3 years, but it might give you up to 200% of profit. I presume the biggest move up is going to happen when they have a good news about the project. When the local regulators, they will tell, okay, fine, all problems are solved, go ahead, and all fantastic. All right. So in this particular case, I presume the jump will be quite high, similar to what we experience now with Tenneco and similar to what we experience with Signet. And even those companies didn't have any good news. It's just the market volatility like that. But if they have good news, the jump might be even higher. Now, if you want to trade on the short trades, so like buy and sell, so if you buy it even on a sliding trend, you still can do it. So if you buy at $28, $29 and then sell at $31, $32, so if it's something like that, so if you buy it here, $28, and then it goes somewhere to that loss level of $31, you might sell it there. All right, don't wait until $39, but sell it somewhere here. It's also might give you up to 20% profitability. But of course, if you do something like that, you need definitely use stop losses, because you're not planning to hold that particular stock for long period of time. Okay, and of course we might consider some naked puts, sell covered calls, or buy lip calls. And so let's have a look. Can we use those strategies or not? Right, and now guys, you're experts in this. I presume you can tell me. So current price is $29, like practically $29. So first of all, kind of bad thing in trading options that the spread is quite big, right? $25, $30, $35. So the spread between strike prices are quite high, and that's why we practically can't use any spreads here. So if you try to use diagonal spread, it's practically impossible to do that. And also even with calendar spread, you might do one trade, but then if the price moves down or up, it's you kind of stuck because the trade options here is quite low. For instance, if you look at 10-day and $30 strike price only, if you sell call, you might get only 20 cents, which is less than 1%. Okay, so here on this side, if you sell put, you get $1.15, $1.02, it would be intrinsic value. So 13 cents, that would be time value, which is even lower than that, half of the percent. Okay, so time value is not that big in here. Now, if we go for 38 days, so what we can see here, we can see here that we get 80 cents for a $30 strike. So it's less than 3%. Okay, and if we sell puts, so we get roughly the same time value. Okay, but higher premium here because of this intrinsic value. By the way, guys, the question for you, what would you prefer here? Sell put or buy shares and sell call? From time value perspective, it's exactly the same. So what would you do? It's kind of a tricky question a bit. You have to consider what kind of company it is. Correct, Nick. So because for dividends, you might get extra dollar if during that period of time you're going to get dividends, definitely buy shares. Because the risk is exactly the same, but if you own the shares, you get extra dollar. Okay. So if we look at the buy leap call, so we have only January 2020 and we have April 2020. So we have 129 days. So it's a bit more than 4 months. And here we have about 7 months, a bit more than 7 months. So that's what we can see here. So here for $30 strike price, we have to pay $1.20, 145, sorry, and here 175. So out of these two, do you think, first of all, are they expensive calls or not? Are they expensive or not expensive? No, they're not at all. They're not expensive. The spread is also quite good, only 15 cents. So if you buy, for example, $30 call, you're going to pay only $1.75, which is close to 5%, a bit more than 5%, maybe 6% for 7 months. If the share price goes to $32, you're going to practically probably double the money there. Okay, if it goes to $39, you kind of get 10, like 5 times or 6 times of money invested. And by buying this leap call, you also know that you're not going to lose more than $1.75. That would be the lowest thing. So if you, for instance, buy right now $29 shares and it's continued to slide and goes to 25, your loss would be around $4 if you decide to sell it there. Whereas here you kind of fix your possible loss for $1.75. This is kind of another alternative to buy shares. But remember, if you buy leap calls, you're not getting any dividends at all. Okay, and of course, if there is time passes and in April it doesn't go higher than that, you're going to lose all the money here which we invested. Whereas with the company, you can wait through that period, get dividends, reinvest the dividends. For instance, with this specific company, I got dividends and I put the order today to buy more shares. Okay, so from the profit which I received distribution. So I kind of reinvest in dividends back to the same companies. Okay.